Someone is going to offer you a financial opportunity this year. It might come through Instagram, through a friend, through a professional looking website, through someone you trust, and it is going to sound good. Too good, maybe, but not so good that the alarm goes off immediately. Just good enough to make you consider it. These are 5 of the most common financial red flags that cost young people real money every single year, globally, across every income level, across every background. Know them before you need them. Let me describe a moment that happens to millions of people every year. You are scrolling. You see a post. Someone your age, nice car in the background, relaxed energy, credible looking profile, talking about how they made serious money from a specific opportunity. It could be forex trading, a crypto signal group, a passive income system, a business model that keeps getting described in vague but exciting terms. Something about it pulls at you. Not greed exactly, just the feeling that everyone else is figuring something out and you are still waiting to start. That feeling, that specific pull between skepticism and wanting to believe, is the entry point for every financial red flag on this list. And recognizing the pattern before the money leaves your account is worth everything. Red flag 1: guaranteed returns. If anyone, a person, a platform, a registered company, anyone, guarantees you a specific investment return, walk away. Not because high returns are impossible, because returns from genuine investments cannot be guaranteed. Markets move, interest rates change, businesses underperform, default rates shift. No legitimate investment vehicle can promise you 8%, 12%, or any fixed percentage return without exposure to the possibility of loss. Guaranteed returns are the language of two things: fixed income products like government bonds and guaranteed investment certificates, which offer modest, transparent, regulated returns, and fraud. The distinction is simple. Legitimate guaranteed products are low return, heavily regulated, and issued by government-backed or heavily regulated institutions. They do not come through Instagram DMs or WhatsApp groups. If the guarantee is attached to something exciting, high returns, a new platform, a special opportunity, it is not a guarantee. It is a hook. The Ponzi scheme, the oldest financial fraud structure in existence, works entirely on this principle. Early investors receive returns funded by new investor money. The guarantee holds until the new money stops coming. Then everything collapses. The people who got in late lose almost everything. Ponzi structures exist in 2026 in more sophisticated digital packaging than ever before. The guarantee remains the tell. No legitimate investment guarantees returns. Full stop. Red flag. 2. Paid signal groups, forex gurus, and crypto trading courses with lifestyle marketing. You have seen this ecosystem. Someone on social media, often young, often displaying visible wealth, promotes a forex trading group, a crypto signal service, or a trading course. The pitch: follow our signals and make money. The price: a monthly subscription or a one-time course fee. The red flags are specific. The income claim is lifestyle-based: cars, watches, travel, not verified, audited, or regulated return data. The strategy requires you to pay before you see meaningful evidence of consistent, verified performance. The business model generates more income from selling the course or subscription than from the trading itself. This is almost always true and almost never disclosed. In many countries, providing investment advice or signals for compensation requires regulatory licensing. Operating without it is illegal. Many of these services operate in regulatory gray zones deliberately, moving between platforms, jurisdictions, and identities when scrutiny increases. This does not mean all trading education is fraudulent, but the specific combination of unverified lifestyle marketing plus paid signals plus vague regulatory status is a pattern with a consistent outcome for buyers. Most people who pay for these services do not make money from the signals. They make the signal provider money. Red flag 3. Payday loans and high-cost short-term credit. This one does not come with a flashy social media campaign. It comes with a storefront, a website, or an app that promises fast cash with minimal requirements. Payday loans, called payday loans in Canada and the US, doorstep loans in the UK, cash advances in Australia, are short-term credit products typically charging fees that, expressed as an annual percentage rate, can run from 200 to over 1,000% depending on jurisdiction. The structure: borrow $300, repay $345 in 2 weeks. That $45 fee on a 2-week loan represents an annualized rate of approximately 390%. The trap is not the first loan, it is the rollover. When the repayment date arrives and the full amount is not available, the loan rolls over with another fee, then another. The $300 emergency becomes a $600 obligation within a month. In markets where payday lending is less regulated, some jurisdictions in parts of Africa, Asia, and Latin America, the rates can be even higher and the enforcement of repayment more aggressive. Emergency credit needs are real. Payday loans are almost never the right solution to them. They convert a temporary cash flow problem into a compounding debt that often costs more than the original emergency. The alternative? A proper emergency fund, which we have covered extensively on this channel, is the structural solution. For genuine emergency credit needs, credit unions and community banks in most countries offer emergency loan products at significantly lower rates than payday lenders. Research these options before an emergency arrives. Red flag 4. MLM and network marketing income opportunities. This one requires nuance because multi-level marketing, MLM, is legal in most countries and not every MLM company is a scam. But the financial reality for most participants is consistently poor enough that the red flag pattern is worth understanding clearly. The pitch: join our network, sell products, recruit others who sell products, earn commission on your sales and on the sales of everyone you recruit, build passive income. The reality disclosed by the income disclosure statements that many MLM companies are required to publish, and which most participants never read before joining, is that the significant majority of participants earn little to nothing from the venture. In many cases, they spend more on required product purchases than they earn in commissions. The red flag specific to income-focused MLMs. The income opportunity is emphasized more than the product itself. Joining requires purchasing an inventory or starter kit, meaning you are the customer before you are the business. Advancement in the structure depends more on recruitment than on retail sales to genuine external customers. Income claims in the marketing are lifestyle-based and unverified rather than drawn from the company's own income disclosure data. Selling products you believe in to people who genuinely want them is legitimate commerce. Paying to join a structure where your primary path to income is recruiting the next person who pays to join is a different model, and one with a documented financial outcome for most participants. Read the income disclosure statement before joining anything with a recruitment component. The data is usually publicly available. The numbers are usually sobering. Red flag 5. Financial advisors and salespeople with undisclosed commission structures. This is the most sophisticated red flag on the list because it can come from someone with professional credentials, a regulated license, and a genuine belief that they are helping you. In most financial markets globally, 2 types of financial advice exist. Fiduciary advice. The advisor is legally required to act in your best financial interest. Their recommendation must be the best option for you, not the most profitable option for them. Suitability advice. The advisor is required only to recommend something that is suitable for your situation, not necessarily the best option available. They may earn commission on the products they recommend, The problem: most consumers cannot tell the difference. Both types of advisor can hold professional designations. Both can seem credible, helpful, and knowledgeable. The specific red flag pattern: an advisor recommends an investment product without clearly disclosing whether they earn a commission on the recommendation. The product recommended has a higher fee structure than comparable alternatives, and the advisor does not explain why the higher cost is justified. The advisor is employed by a single institution and recommends only their own institution's products, without comparing alternatives in the broader market. The question that protects you: are you a fiduciary? Do you earn any commission or compensation if I purchase this product? A legitimate advisor will answer this question directly and clearly. An evasive or defensive answer to this question is information. In many countries, including Canada, the UK, Australia, and the US, fee-only financial planners exist. They charge a flat fee for their time and have no financial incentive to recommend any specific product. For significant financial decisions, a one-off consultation with a fee-only planner is often worth the cost. Let me put rough numbers on what each of these red flags costs when people do not recognize them in time. Guaranteed returns fraud. Average losses for retail investors caught in Ponzi-type schemes range from a few thousand to complete loss of invested capital. The average reported loss in financial fraud cases involving ordinary investors is typically in the range of $5,000 to $20,000, depending on the market and scheme. Paid signal group: average spend on course or subscription before exit: $300 to $2,000. Trading losses from following unverified signals: highly variable but consistently negative in aggregate for most participants. Payday loan cycle: a $400 emergency loan that rolls over 4 times before being cleared costs approximately $600 to $800 in total repayments. A $400 problem becomes an $800 problem. MLM participation: average net loss for participants who do not reach upper tiers in the compensation structure: $500 to $2,500 in product purchases, marketing materials, and event fees before exit. Commission-based financial product: a managed fund with a 2% annual fee versus an index fund at 0.2% on a $30,000 portfolio over 20 years. Approximately $40,000 to $60,000 in lost compounding due to the fee difference. 5 red flags. Combined potential cost to a single person who encounters and acts on all of them across their 20s: potentially $50,000 to $80,000 in direct losses, unnecessary costs, and lost compounding from not knowing what to look for. 5 red flags. 5 protective questions. 1. When someone guarantees a return, ask, what regulatory body oversees this guarantee, and what happens to my capital if the projection is not met? 2. When someone sells trading signals or courses, ask, where is the independently audited return data for this strategy? 3. When short-term credit is being offered, ask, what is the annualized percentage rate and what happens if I cannot repay on the scheduled date? 4. When a network marketing income opportunity is presented, ask, can I see the company's income disclosure statement? 5. When a financial advisor makes a recommendation, ask, are you a fiduciary? And do you earn any compensation if I take this recommendation? 5 questions. Any one of them, asked directly and answered evasively, tells you everything you need to know. Here is the reframe. Financial red flags do not always look dangerous. They are often presented by people who seem credible, friendly, and genuinely excited about what they are offering. The protection is not cynicism about everyone. It is a specific, short list of questions that legitimate financial products and advisors can answer clearly, and that fraudulent or exploitative ones cannot. You do not need to be suspicious of everything. You need to ask the right questions of anything. Someone is going to offer you a financial opportunity this year. Maybe it will be legitimate. Maybe it will be one of these 5 patterns dressed in new packaging. The difference between losing money and protecting it will not come down to whether you were smart enough. It will come down to whether you knew the 5 questions. No legitimate investment guarantees returns. No credible trading signal service cannot show audited results. No responsible emergency credit product charges 300% annualized. No honest MLM income opportunity hides its income disclosure data. No fiduciary advisor deflects the question of whether they earn commission. 5 patterns, 5 questions. A financial life that does not include an expensive lesson learned the hard way. You now have both. Drop a comment and tell me, have you encountered any of these 5 red flags in your own life? A signal group you almost joined? A guarantee that sounded real? A payday loan that became a cycle? Tell me what happened. Your experience might be the thing that stops someone else from making the same move. I read every comment. If you know someone who is currently being presented with any of these 5 patterns and has not yet acted, share this video today, not next week, today. The window between consideration and commitment is often very short. Subscribe to Nuella Invests. Every week, we make sure you know what to watch for before it costs you. See you in the next one.